difference because we're working in so many different time zones. But anyway, I'll make a start whilst other people join. So today we're going to talk about the currency chaos we're seeing around the world and some ways you can take advantage of that, or at least protect your wealth, because the currency turmoil is also linked partially to inflation, which gets me on to the first point, which is, in simple terms, why is this happening? Why is the US dollar getting stronger against almost all major currencies in the world? Well, in simple terms, during times of economic turbulence, the US dollar is seen as a safe haven. So we saw this in 2008. The dollar was weakening for that decade, but then it got stronger in the first year of the financial crisis. We saw that in 2020, and we're seeing it again this year. So last year, the US dollar gave up some of its gains from 2020, but this year it's getting stronger. And we're also going to talk about some of the strategies to take advantage of this, and in different assets as well. And we're going to have a Q&A at the end of the session as well. So as mentioned, the US dollar is primarily getting stronger because of the reason I alluded to. However, we also have to bear in mind that the US Federal Reserve is increasing interest rates at a quicker rate than some other central banks. So for example, the Japanese central bank hasn't increased interest rates as much as in the US. The Turkish central bank is even trying to, or the Turkish government, which is influencing the central bank, is even trying to stimulate the economy and lower interest rates. And even in the UK, there's a lot of talk about why the pound went down. Was it because of politics and whatever? That was certainly one of the reasons. But another reason is the US Federal Reserve increased interest rates by 0.75%, whereas the Bank of England in the UK did it by 0.5%. So the US Federal Reserve in the US are being much more aggressive in terms of increasing interest rates. But this period definitely won't last forever. The US dollar is not going to go up in a straight line. However, we do have to remember that things don't always go back to the way they were. So will the British pound ever go back to 2-to-1 against the dollar like in 2007? Maybe, but maybe not. Likewise, the South African rand or the Ghanaian cedis, if you look on Google, even to the ultra long term, the general trend has always been down, at least in the last 30, 40 years against the dollar. So even though the US dollar won't get stronger forever against a basket of currencies, we can't assume the currencies always get back to where they were. Because even if you take, say, the British pound, historically, actually, if you go back long enough, it was £4 to the dollar or £5 to the dollar. So it won't necessarily, go back to even 2-to-1, never mind what was the norm 100 years ago. So if you've got cash in the bank and you're kind of worried, well, it's now a bad time to invest, you have to bear in mind that some currencies do never recover. Now, this graph, and this shows how we're moving, how fast we're moving. This graph, is already a bit out of date, because if you look in the graph, you'll see that the UK currency, at the time of the graph being made, the British pound had lost over 20% of its value against the dollar, and the yen was about the same, a bit less. But since this graph has been made, you might have seen on the news that the Japanese yen has gone down further against the US dollar. But nevertheless, one thing that is still the case is that most currencies have got weaker against the US dollar. The exceptions are currencies that have been weak for quite some time, like the Brazilian and Mexican currencies. Some currencies are pegged to the dollar, of course, like the Hong Kong dollar or the Saudi Arabian currency. Russia's the big outlier, but Russia, it's complicated because now they're saying, well, you have to buy in rubles when it comes to oil and gas and so on. So that's kind of a bit of a, let's say, an artificial rise, because the ruble's gone from a free market open kind of currency to now something which is a bit more restricted, and there's more government intervention than before. So basically, the average currency has gone down about 15 or 20% against the dollar, but some emerging market currencies like Argentina, also the Ghanaian cedis, has gone down further than that. Now, what's interesting about this is if you look at the last graph, the Turkish lira is one of the worst performing currencies. But the Turkish stock market, even in US dollar terms, has been the best performing stock market this year. And what's interesting is people are asking, well, why is that? And the best explanation is that because the currency is so weak and inflation is so high, people in Turkey, not all of them obviously, but a reasonable percentage of middle class and wealthier people, see no alternative about what to do with their money apart from putting it into real estate and stocks, both in the home market and international market. What was interesting is I was in an international convention earlier this year, and I've been to that convention before. And this time, this time I noticed that there were more Turkish people at the convention, and I was talking to them, and basically they mentioned that many people are investing overseas now and also locally because of the inflation issue. And I think we also have to remember that whilst cash in the bank doesn't always recover, asset prices, even though they can go up and down, in the long term, they do tend to go up if you invest in the right areas. So what's interesting is in those countries which have had very unstable recent times, like Turkey and Brazil, actually a lot of people are saying, you know what, it might not be perfect, some of the assets, but at least if I put my money in houses or the stock market, yeah, it might go up and down, but in the long term, I should be okay. So it's actually very interesting what's occurring. Some of the best performing stock markets are in areas where people feel like there's no real alternative, or certainly cash because of inflation is not an alternative. And we're going to get into that in more detail later in the webinar. So the first thing I want to talk about, so we're going to talk about different strategies to protecting your money. But one thing we do have to bear in mind is valuations are much lower now across the board when it comes to stock markets compared to 6 to 12 months ago. So the US stock market, the price to earnings ratio is just one way of looking at valuations. But the US stock market valuations are already much lower than where they were. You can see on this valuation metrics, the year 2000 was a time when stocks were very overvalued, but you can see it's fallen quite a bit in the US. But non-US markets are much more extreme. So you can see, if we go back to the US one, we can see valuations are still pretty high, but they have been at this level many times before, but they're still higher than average. Whereas some other stock markets, like for example, the UK and mainland Europe, valuations look really quite cheap now. And some ASEAN stocks in the Southeast Asian region, some stock markets and portfolios are trading at 8 times price to earnings ratio, which is essentially very cheap because the US stock market has been trading at 20 times or 30 times, many times, especially the Nasdaq in the last few years. And one of the reasons I think why this is happening is that basically the market, we said that the US dollar is kind of a safe haven during bad times, but the US stock market is also seen as a bit or much less risky than, say, the Vietnamese stock market or even the British or European stock markets. So basically, when that happens, even though the US stock market has gone down, you can see that basically valuations have still kind of done okay. I mean, the Dow Jones is now still at 31,000, for example. So if people are willing to take a bit more of a risk, sorry, I mean, I've got a bad throat at the worst possible moment during the webinar. But yeah, if you're willing to take a bit of a risk, but not a huge risk, even those kind of traditional kind of developed markets like Japan, like mainland Europe, like the UK are pretty cheap now. And some developing markets like in ASEAN, really quite good valuations in some cases. Now, this is an interesting graph. So one of the major questions I get asked is, well, which currency should I invest in? And what's interesting is investing is a way of protecting you from currency devaluation. So far this year, the S&P 500, this was like a lot of the statistics on this graph. This was from a few days ago. In the last week, basically, I made this presentation. So at the time of making the presentation, it's gone down 23% in US dollar terms, which is quite a decent fall, right? But the same fund, the iShares S&P 500, but denominated in pounds, has only fallen by 7%. And obviously it pays dividends. So that means a British pound investor, they would have reinvested dividends, would only be about 5% down. Even in euros, it's only down 10 or 11%. And if you look at the last 10 years, in US dollar terms, a US dollar investor's made just less than 10%, whereas euros and pounds has been 10 to 13, 14% per year annualized for the last 10 years. So it just shows you that, you know, if you invest in a diversified global portfolio, it does protect you from big falls if your currency is going down. So for example, Japanese yen investors, if they were investing in the US stock market, many of them are now up for the year. And obviously people who are investing in Turkish or Argentinian currency are very much up. So that shows you the benefit of an internationally diversified portfolio. However, having said that, if you're a US dollar-based investor, obviously you have been affected a bit by our markets. So for example, the British market is only down about 10% or less than 10% this year, but adjusted for the fall in the pound, it's higher. So we have to bear in mind that that's also an opportunity for people who have US dollars, and we're going to talk about that more, you know, later in the presentation. So we're going to talk about some strategies that can be used. So we've already spoken about obviously just taking advantage of lower valuations, and we're going to give some examples of that. But another thing we can focus on is dividends. Now, if dividends are reinvested back, it's a huge advantage to a portfolio. So just in the same way that if you buy real estate, if the capital value is going down, but you're making 6% on the rental yield, you're not going to be too unhappy, right? Because you'll know that if the price recovers and you're making 6% per year, it's still doing okay. And the same thing is true for the stock market. So people, when it comes to the stock market, they're only focused on capital gains. And often it's because of the news. They'll say, oh, the Dow Jones is up 2% today or down by 2%. But we have to remember that the stock market pays dividends. So that's a huge component of investing returns. So the S&P 500, about 60 to 70% of the returns since 1945 have been from dividend reinvesting. And I've given you some examples of some dividend ETFs there. And those could be certain things to look out for, because also the price to earnings ratio and the general valuations of dividend stocks are still quite low at the moment. However, be careful where you buy the ETFs, because if you're a non-American and you buy dividend paying ETFs on the New York Stock Exchange, you face a 25% withholding tax. And if you're an American person investing overseas, it's better not to do that. Basically, it's better to invest on the New York Stock Exchange. The good advisor can explain that in more detail. It's quite a dry topic, tax and investing, but just be a bit careful where you buy these kind of investments. And what's interesting is the Vanguard Group, which is the second largest financial group in the world after Vanguard. They produced a very interesting analysis about a week ago, and they said two things. Number one, in the next 10 years, they've now revised up their projected returns for stocks and bonds because the valuations are now lower. But in addition to that, for US dollar-based investors, they are now more optimistic about non-US stocks, because let's say if you're investing in, I don't know, the UK stock market as an American, or somebody who's a non-American who has US dollars now, and you're getting a 4 or 5% dividend yield, a weak currency, low valuations, even if one or two of those things change, like the pound goes up even a little bit against the dollar, valuations climb just a little bit, in addition to a 4 or 5% not rental yield, dividend, all of a sudden you've got a 7, 8, even 10, 12% return, right? Because you're gaining from 2 or 3 different angles. So the weak euro and US dollar and our currencies, in addition to the weak valuations, is an opportunity for US dollar investors, those people who have got US dollars, basically. Another thing you can do is look at non-stock market assets. So we do have to remember, though, that basically property is much more risky at the moment than has historically been the case. Interest rates could rise a lot, although I don't think that's going to last forever, because I think once interest rates rise above a certain point, the central banks might decrease them and try to stimulate the economy again. You can imagine in 1 or 2 years, if inflation has fallen because there's a recession, interest rates might have to go down again. But for the next 6, 12, 18 months, probably property is much riskier than has historically been the case. By the same token, we have to remember that property is looking much cheaper now than before. Again, especially if you're a US dollar-based investor, because, for example, the average house price in the UK today is cheaper than it was in 2007 in US dollar terms. So the average price of property in the UK has fallen in the last 15 years in US dollar terms, and that's not even including inflation. So there are opportunities, and obviously in emerging market property and so on, but that's also pretty risky. The second point is traditional fixed income could become viable in 1 or 2 years. Now, what do I mean by that? Traditional fixed income is things like government bonds. The problem with government bonds recently is interest rates were so low that they were only going to come up. So that meant the government bonds weren't going to perform as well as historically has been the case. But as I was saying, someday, it could be next year, it could be in 2 years, it could be in 3 years, bond yields will have to, or interest rates will have to go down, and that could actually drive up the price of government bonds. But still, the return on government bonds is still so low that untraditional fixed income should play a part in someone's portfolio. That could be corporate debt, or it could be various other investments like downside protected investments, which a good advisor can give you access to. But I think in the current environment, if you don't want to have the majority of your assets into the stock market, it isn't viable to have like 60% in cash and government bonds, which was the traditional approach, because both are paying so little. But you can look at traditional fixed income as well. One thing that some people are trying to do at the moment is get into things like Chinese government debt and our government debt, which is paying a bit more than, say, US government debt. But again, obviously risks exist when it comes to that. Another thing you can consider is dividend stocks. So we spoke about dividend ETFs, which are much lower risk and better way for 99% of investors, because you're not facing individual company risk. But if with just a small percent of your portfolio, say 10%, you want to look at individual names, there are some dividend growth stocks where these companies have provided good growth, solid dividends of 6 or 7%, and they have low price to earnings ratios, which show they are undervalued or fairly valued. So Devon Energy is just one example of many I could give. The price to earnings ratio is low. I think they're paying about 7.2% or so dividend yield. At least the US one is. They've got one listed in the UK as well. And also it's provided good growth in the last 10 years. But again, obviously risks exist when it comes to individual positions, and the stock has already gone up quite a lot this year, and indeed since I made this presentation. So that's not a kind of mainstream play, if you like. It's not something to put 50%, 80% of your portfolio in, but it's something that some people might want to do with a minority of their portfolio. Now, one thing we also have to bear in mind, and this is something that people forget, is the way that compounding works isn't always logical. Because if you think about it, if you've got $100,000 and your portfolio falls by 50%, so it goes to $50,000, to get back to $100,000, you need to double your money, right? And 100% upside. But a lot of people think, well, if the market crashes, I'm going to recover only when the market gets back to where it was. But that's not the case, because even if you don't put extra money into the market, well, sorry, that was I misspoke. Obviously, if you just keep your initial money and it goes down and it recovers again to the same point, then yes, you would have recovered to the same point. But let's say the market's gone down, you reinvest dividends, as we spoke about before, you put extra money in, then actually, if it actually goes back up to where it was, you're going to make a good profit. So that doesn't mean you should try to time the market. That doesn't work, as I've said many times online. But it does mean that when asset prices fall, in many ways, it's a good opportunity if you do happen to be liquid. And let's face it, most of us either get a salary or business earnings. So most of us have to put into the market at different times. So we see some examples in recent times. So, for example, during the 2007 crash, markets came back by over 400%. In 1987, it was close to 600%. And this is pretty normal that when markets are at their lowest point, obviously the profits are kind of can be immense. Even with assets like property, you can kind of gain access to good returns if you buy at a low point. Now, again, I want to say I'm not encouraging people just to keep money in cash to kind of take advantage of these valuations, but I think the point is having money in cash sometimes is more risky than assets, as long as you have an internationally diversified portfolio. And if you can take advantage of moments like this, then it's always a good chance. But we do have to remember as well, as per the third point, that individual positions don't always recover. So whilst the general market, say the S&P 500 or the Dow Jones or whatever, has always recovered, especially for reinvesting dividends, if you do that, individual positions don't always recover. So it's not just Lehman Brothers. Individual stocks might not always recover. So when it comes to a portfolio, you always have to consider, well, is it an individual position or is it the general market? And if it's an individual position, you have to ask yourself, is this ever going to recover or not? Or is it likely to recover as well? Now, another strategy you can use to kind of hedge against kind of currency weakness or inflation or so on is dollar cost averaging, which is just a fancy way of saying investing every month. But what's interesting is I looked at the period from 2000 until 2010. And the reason I looked at that is it was a so-called lost decade for the US stock market. So the US stock market did 0% from 2000 until 2010. If you had bought into the US stock market on January the 1st, 2000 and sold out at the end of 2010 or at the end of 2009, you would have basically made zero. However, if we look at what's happened here, basically, if you reinvested dividends, you would have made about 25% in the US stock market. So the capital gains or the capital growth was zero, but by reinvesting dividends, you would have made about 25%. So not great, but about 2% per year. So it was a low inflation period. So you're basically matching inflation if you would have reinvested dividends. However, bond markets, bonds were producing much better returns in those days, and bonds produced about 100%. So they doubled your money in that period. But emerging markets, which had a very bad last decade, they actually produced 233% in US dollar terms in this period because emerging market currencies were getting stronger. It was a good time for emerging markets. So what's interesting is it was a lost decade only for people who put in a one-off lump sum into the US stock market. But if somebody would have, put in a monthly investment, had some in international markets, including emerging markets, some in the bond markets, they would have done quite well from a risk-adjusted perspective. And in addition to that, talking about monthly investors, if someone would have put in $1,000 a month into the US stock market from 2000 until 2010, the ending balance would have been $200,000 or approximately $200,000. And the bond market only produced a little bit more, and emerging markets did do much better. But what you can see here is there's a huge gap, if you notice, between somebody who put in a lump sum versus a monthly amount, because with the lump sum, government bonds easily beat the US stock market in this period. But for a monthly investor, it was almost even. And the reason for that is simple, that basically from 2001 until 2003, and also from 2008 to 2009, valuations in the stock market were so cheap that basically people were buying on sale, right? So if we come back to here, people were getting this huge advantage. If you see 2007, how quickly the stock market rebounded. So that helps explain why monthly investors did pretty well. So what you can see from all of this data basically is people who are just in one asset class, like for example, even something like the US stock market, which has had 100, 200 year history of producing good returns, they can have a lost decade. But if somebody reinvests dividends and they're in 2 or 3 different asset classes, markets in different parts of the world, they can actually do pretty well. And I think that's the key point. We're always told as children, don't put all your eggs in one basket. And I think, being 100% in one currency, just having cash in the bank is very risky for obvious reasons. Being in one stock or share is very risky. Being in one stock market, not so much, because you've got hundreds of different stocks. But even when it comes to the US stock market, you're going to reduce your risk as an international investor if you have access to other investments, because we're seeing here that emerging markets had a great period during the so-called lost decade of 2000 until 2010. But the last decade, they haven't done so well. So these things go in cycles. Different asset classes can perform well at different time periods. Same with government bonds. They performed very poorly recently, but they did well in this period. So you always have to remember that we can't always say that just because something's performed well recently, that it will in the next decade. And I think what's interesting is we've come through a period of very strong US stock market performance for about 10 years, 15 years. International stocks have lagged behind, the UK, Europe, Japan, and so on. And it might be time for that to change. So some conclusions then. So investing internationally reduces your currency risks, because just as a British pound investor has done better if they've invested internationally in the last 5 years than a US dollar investor, and say a Turkish lira investor has done much better than a British pound investor. If you invest internationally, you are getting access indirectly to loads of different currencies. You don't have to even convert your money in many cases to get that exposure. Now, global indexes, including the US ones, reduce currency risk, but it's better not to just operate in one market, as we said. So if you've got your money in many different markets, many different asset classes, bonds, property, the markets, the stock market, your risks, including your currency and inflation risks, are much lower compared to if you're just in cash, or indeed just in, say, 1 or 2 individual stocks. Lower valuations are definitely a long-term opportunity. So right now, at least if priced in US dollar terms, some property markets are looking very cheap, but it's a bit more risky. And some international markets in the stock market, the UK and emerging markets, are looking very cheap as well. So once we see some kind of rebound, US dollar investors will definitely benefit from that. And that's backed up by the Vanguard research I spoke about before. Okay, everyone. Any questions that you would like to ask? You can ask in the chat function, and I'll give my my throat a little bit of a rest for a few seconds. Now, one question I did have asked privately on the chat was, if I saw the British pound, do you think it's likely to go up? Now, of course, I can't know for sure what's going to happen. But if I was a betting man, I would say, unless Sunak doesn't last, basically, I do think the pound, maybe the sell-off was a bit overdone. And there's a chance the pound will go higher. But having said that, a lot of analysts are saying that the British pound now is looking a bit like an emerging market currency. I think that might be taking it a bit too far, but I do think it's much more risky now. So could the pound be a 0.8 in a year's time? It could be. I don't think it will happen, but it could be. So I think having a lot of cash is a lot riskier than people assume anyway, but in the current environment, the pound could be up by a dramatic amount or down by a dramatic amount in the next year or so. So it's particularly risky at the moment. And I think emerging market currencies could even fall into some of them could even fall into a collapse, like the lira as well.